So think about the sheer number of decisions you've already made today. I mean, literally from the moment your alarm went off.
Right.
Like, do you hit snooze or do you actually get up? Do you make coffee at home or do you buy it on the way to work?
It's constant.
It is. And, do you take the highway, which might have a bunch of traffic, or the back roads, which, well, they take longer, but they keep you moving? By the time you even sit down to start your actual day, your brain has already processed like dozens of little risk-reward calculations.
Oh, absolutely.
And the fascinating thing is, most of the time, we're making these choices using completely flawed math.
Yeah, we really are.
We factor in things that just shouldn't matter, and we ignore the things that actually do, and we end up exhausted and, honestly, quite often making the wrong call.
It's kind of the cognitive equivalent of trying to navigate a ship while you're staring at a compass that's being heavily influenced by, like, a magnet in your pocket.
Wow, yeah, that's exactly it.
We are just incredibly susceptible to noise. We let irrelevant data distort our view of reality. And, in a world where we are constantly bombarded with information, the single greatest survival skill you can develop is the ability to ruthlessly filter out that noise, to just figure out what actually matters.
And that is exactly what we are doing today. So welcome to the deep dive. The mission for you today is to, well, completely rewire how you look at everyday choices.
It's a big promise, but we can get there.
We can. Because whether you are figuring out your personal budget or trying to decide if you should walk away from a project you poured hours into, or even running a massive multinational corporation, there is actually a secret to basically never making a bad decision again.
Yeah.
Today, we're looking at a framework that forces you to focus only on the costs and benefits that actually change based on the choice you make. It's really about isolating the truth.
Right, and the technical term for this framework is differential analysis. But at its core, I mean, it's simply a philosophy of clarity.
Philosophy of clarity, I like that.
It really is. It's the practice of looking at two alternatives and basically discarding anything that remains identical between them.
Okay.
So if a cost or a benefit does not change, regardless of which path you take, it's irrelevant. You must ignore it. The only things that matter are the things that differ.
Okay, let's unpack this with a really simple, relatable example before we get into the heavy stuff. Let's talk about Friday night plans. You're trying to decide, do I go out to a movie theater or do I just stay home and rent a movie on my TV?
That is a perfect starting point. So you have your two alternatives. Now, you need to identify the avoidable costs.
Avoidable costs.
Right. An avoidable cost is simply a cost you can eliminate by choosing one path over the other. So if you go to the theater, you avoid the cost of the digital rental at home.
Makes sense.
And if you stay home, you avoid the cost of the theater ticket and, the overpriced popcorn.
Oh, the very overpriced popcorn.
Exactly. So both of those are avoidable. Therefore, they are relevant to your decision. You weigh them against each other.
But wait, what about the rent for your apartment? Because, I mean, whether I'm sitting in the theater eating that popcorn or sitting on my own couch, my landlord is still charging me the exact same amount for that evening.
Precisely. Your apartment rent is an unavoidable cost in this specific scenario. It does not change based on your choice of entertainment.
Right.
Because it doesn't differ between the alternatives, it is mathematically irrelevant. If you try to factor a portion of your monthly rent into the cost of, staying home to watch a movie, you are introducing noise. You're distorting the reality of the decision.
Well, it makes total sense when we were talking about, a $12 movie ticket and a fixed rent payment. It seems obvious. But when the numbers get bigger and the stakes get higher, our human brains start to glitch.
They absolutely do.
We start clinging to that noise. So I want to look at the anatomy of a real decision to see how this works in practice, because this brings us face to face with one of the most powerful psychological traps out there. Let's look at a scenario involving a graduate student named Cynthia.
Ah, yes. Cynthia is a fantastic case study in how our emotions sabotage our math.
They really do.
So she's an MBA student living in Boston. She has a friend down in New York City, and she wants to go visit for the weekend. The distance is 230 miles each way, so she's looking at a 460-mile round trip.
Okay, 460 miles.
Yeah. And she's on a tight student budget, so she wants to make the most financially rational choice possible. The two alternatives are drive her own car or take the train.
Right. So Cynthia sits down with a notepad, and she starts listing out every single cost associated with owning and operating her car. And I mean everything.
She's very thorough.
She is. She writes down that she originally bought the car for $24,000. She calculates that the car drops in value on paper every year, what accountants call straight-line depreciation, which comes out to about $2,800 annually.
And she doesn't stop there. She adds in her yearly auto insurance premium and her vehicle registration license fees, which combine to $3,380 a year.
That's a lot for a student.
It is. She also pays for a dedicated parking spot at her university in Boston. That costs her $45 a month.
No, I want to pause right here because I deeply empathize with Cynthia's mindset.
Oh, sure.
If I just drain my savings account to spend $24,000 on a car, and I'm paying over $1,000 a year just to insure it, and I'm paying my school every single month just to park it, I mean, I am going to feel an immense psychological pressure to use that car.
Of course you are.
Letting it sit in a parking lot while I go buy a train ticket feels like a massive waste of money. It really reminds me of a gym membership. Have you ever bought a really expensive membership to a fancy gym and you force yourself to go at like 5 in the morning, even when you are exhausted and miserable, purely because you feel like you have to get your money's worth?
That is the exact psychological mechanism at play. Behavioral economists call it the sunk cost fallacy.
The sunk cost fallacy.
Yes. It is incredibly difficult for human beings to overcome because we are fundamentally loss-averse. We just hate the idea of wasting resources. But, we have to look at the cold, hard reality of differential analysis.
Right.
A sunk cost is a cost that has already been incurred. It's in the past. The transaction is complete, and it cannot be undone regardless of what you decide to do today or tomorrow.
So the $24,000 she spent on the car?
It's gone.
Wow.
Whether she drives to New York, takes the train, or literally stays in her apartment all weekend, she does not get that $24,000 back. Therefore, it does not differ between the alternatives. It is completely irrelevant.
That is such a bitter pill to swallow. I mean, it feels wrong to just cross a number that big off the notepad.
It does feel wrong, but it is the only way to see clearly, and it applies to the other fixed costs as well. The $2,800 in accounting depreciation is just a paper exercise spreading out that initial sunk cost, so that is irrelevant. Her insurance premium of $13,380 is a fixed annual contract. Unless she's planning on getting into a terrible accident on this specific trip that would, drastically spike her premiums, her insurance costs the exact same whether the car is cruising down the interstate or parked in Boston.
And the university parking spot. She pays $45 for the month.
Okay.
If she takes the train, her car occupies the spot. If she drives, the spot sits completely empty for the weekend. Either way, the university is keeping her $45.
Exactly. When you force yourself to look only at what changes, you realize that the massive, intimidating numbers, the purchase price, the insurance, the monthly parking, they're all noise. They are mathematically irrelevant to the specific decision of how to travel this weekend. We have to wipe them off the whiteboard entirely.
Okay, the whiteboard is clean. If we strip away all the sunk costs and the fixed costs, what is left? Like, what is the actual differential cost of Cynthia driving her car to New York?
We build the true cost from the ground up, looking only at the avoidable costs. The most obvious one is fuel. If we assume gasoline costs $2.70 a gallon and her car gets 27 miles to the gallon, she's paying exactly 10 cents for every mile she drives. For a 460-mile round trip, the avoidable cost of gas is $46.
And if she takes the train?
If she takes the train, the car burns no gas and she avoids spending that $46.
Simple enough. Gas is a true variable cost. What else?
Maintenance and repairs.
Okay.
Over the lifespan of a vehicle, things like oil changes, tire replacements, and brake pads are proportional to the miles you put on the odometer. The estimate for her specific vehicle is about 6.5 cents per mile in incremental wear and tear.
Let me guess. Multiply that by 460 miles.
You got it. Multiply that by 460, and you have an avoidable maintenance cost of $29.90.
Okay, so we have gas at $46 and maintenance at $29.90. Are we done?
Not quite. There's a fascinating hidden cost that many people miss, and it is entirely different from the accounting depreciation we dismissed earlier. It's called economic depreciation or real depreciation.
Wait, how is real depreciation different from accounting depreciation?
Accounting depreciation is just a formula based on time. Economic depreciation is the actual tangible drop in the resale value of the car caused specifically by the physical wear and tear of driving those 460 miles.
Oh, I see.
Yeah, every time the odometer clicks up, the Kelley Blue Book value of the car drops slightly. By analyzing resale markets, Cynthia determines that driving the car reduces its future resale value by about 2.6 cents per mile.
Wow. So just by turning the key and driving those miles, she is silently erasing $11.96 from the future value of her asset.
Yes.
That is a very real, avoidable cost.
It is. And finally, we have to look at the destination. If she drives into Manhattan, she can't just leave her car on the sidewalk. She has to put it in a parking garage.
Oh, right, New York parking.
Exactly. Let's say that costs $25 a day for 2 days. That's $50 in avoidable parking fees. If she takes the train, she avoids the garage fee entirely.
Okay, let's tally this up. The true differential cost of driving is the gas, which is $46, the maintenance at $29.90, the economic depreciation at $11.90, and the city parking at $50. That brings the total real cost of driving to $137.86.
Right. Now, you compare that to the alternative. The cost of a round-trip train ticket from Boston to New York is $104.
This is amazing. When we first started, it felt like driving had to be cheaper because she already owned the car. But when you strip away the illusions, taking the train is actually almost $34 cheaper than driving.
Purely from a financial standpoint, yes. The math is undeniable. But this is where I want to emphasize that differential analysis is not about turning you into a cold, heartless calculator who only ever chooses the cheapest option.
Thank goodness.
Yeah. Qualitative factors, the subjective emotional benefits of a choice, are incredibly important, and they are also valid differential benefits.
Right, because the experience of taking the train is fundamentally different from the experience of driving.
Very different.
If Cynthia takes the train, she gets the differential benefit of time. She can sit in a comfortable seat, open her laptop, and study for her MBA for 4 hours. She can read a book. She can take a nap. You cannot do any of those things while navigating highway traffic.
Conversely, if she drives, she gains a different set of benefits. She doesn't have to navigate the subway system with heavy luggage. She has the flexibility to leave exactly when she wants to without worrying about a train schedule. She has a vehicle available if she and her friend want to drive outside the city for dinner.
So how does she make the final call if we're mixing hard math with subjective feelings?
The goal of the framework is to ensure that your subjective, emotional decisions are grounded in the correct financial reality.
Right.
Cynthia might look at the numbers and say, having the freedom of my own car in New York City is easily worth an extra $34 to me. That is a highly rational, totally valid decision.
But she shouldn't make the decision to drive just because she feels guilty about the $24,000 she spent buying the car.
Exactly. You isolate the relevant variables so you know exactly what you are paying for the qualitative benefit. You separate the noise from the signal.
I want to stay with the concept of Cynthia's car for just a minute longer, because there's a massive mathematical trap that people fall into, especially in business, and it relates to how we calculate costs. We need to talk about the danger of unitized or average costs.
Oh, this is perhaps one of the most common and dangerous errors in decision-making. Our brains love simplicity. We love a single, clean number that tells us everything we need to know.
So when Cynthia first made her giant list, the one that included the sunk cost of the car, the fixed insurance, the monthly parking, along with the gas and maintenance, she decided to divide that massive total by the number of miles she drives in a typical year. The result was an average cost of about 62 cents per mile.
It seems like such a useful metric, doesn't it? My car costs 62 cents a mile to operate.
It does, because then you say, okay, New York is 460 miles away. 460 miles multiplied by 62 cents a mile driving to New York is going to cost me $284. If you look at that number, the 144 train ticket looks like the greatest bargain in human history.
But that 284 to Ressler figure is a complete hallucination. It's an illusion created by blending different types of costs together.
Why does averaging them create an illusion?
Because average costs mix variable costs like gas, which truly does increase with every mile together with fixed and sunk costs like insurance and the purchase price, which do not change at all.
Oh, I see.
Remember, her insurance premium doesn't go up because she drove to New York. The $24,000 she paid for the car doesn't increase. But when you create a unitized cost of 62 cents a mile, you are artificially treating those fixed costs as if they behave like variable costs. You are acting as if every mile you drive somehow costs you another tiny fraction of your insurance premium.
It's like mixing oil and water. You can shake them up and make them look like one liquid for a second, but they are fundamentally different things. If you use a blended average cost to make a forward-looking decision, you're going to get a horribly distorted view of reality.
That is exactly right. Whenever you are presented with a cost that is stated as dollars per unit or dollars per mile or dollars per hour, your analytical alarm bells need to ring loudly. You must break that average down and isolate only the incremental, avoidable costs.
Here's where it gets really interesting. I want to scale this concept up. We are going to leave Cynthia and her budget-conscious road trip behind, and we are going to walk into the C-suite of a major corporation.
Let's do it.
Let's look at how the exact same mathematical illusions are used, sometimes deliberately, to justify massive corporate perks, specifically the use of a CEO's private jet.
This is a phenomenal application of differential analysis, and it highlights a crucial principle in accounting, which is different costs for different purposes. The way you calculate a cost depends entirely on the narrative you're trying to support or the specific question you're trying to answer. And regulatory bodies, like the Securities and Exchange Commission, pay very close attention to how companies answer these questions when it comes to executives using corporate assets for personal reasons.
Imagine this scenario. You are the CEO of a massive company. The company owns a Gulfstream V, an absolute marvel of luxury aviation. You decide to take your family on a vacation from New York to Orlando, Florida. It's about a 2,000-mile round trip.
A nice little getaway.
Right. You use the company jet. The question the board of directors, the shareholders, and the IRS want answered is, what is the true cost of that flight? How much value did the CEO just consume, and how much should they reimburse the company?
And depending on the perspective you take, you can arrive at three vastly different numbers for the exact same physical flight. Let's examine perspective one. Many companies use a standard rate set by the Internal Revenue Service.
Okay, what is that based on?
This rate is designed to roughly approximate the cost of buying a first-class ticket on a normal commercial airline for that route.
So under this commercial equivalent perspective, the company looks at the trip and says, well, if he had flown a Delta first class, it would have been about $1,500. So we will say the cost of the private jet trip is $1,500.
Correct. Now consider the reality of flying a Gulfstream V. $1,500 barely covers the catering. It is a rounding error.
It is absurdly low. Which brings us to perspective two, which uses the differential analysis we just learned. Let's look at the incremental avoidable cost. What are the costs that specifically occurred only because this jet took off for Orlando?
If the jet had stayed in the hangar in New York, the company would not have burned thousands of gallons of aviation fuel. They would not have paid landing fees at the Orlando airport. They would not have had to pay for hotel rooms and per diems for the pilot and flight attendants while they waited in Florida for the CEO to finish his vacation.
So you isolate those specific variable elements. You add up the fuel, the landing fees, the crew expenses. What does the incremental cost come out to?
The true avoidable cost of that specific flight is roughly $11,000.
That is a massive jump from the $1,500 IRS rate. But critics of executive compensation argue that even the $11,000 number is a mathematical illusion because it ignores the macro reality of owning a private air force.
Yeah.
This is perspective three.
Perspective three zooms out to look at the total market reality and the long-term impact on the company.
All right.
Critics point out that if a CEO and other executives are constantly using the company planes for personal trips, the fleet is constantly deployed. To maintain readiness for actual corporate business, the company is eventually forced to purchase, staff, maintain, and insure additional airplanes.
So you can't just look at the fuel burned on one trip.
Yeah.
You have to recognize that this personal usage contributes to the massive fixed overhead of running a corporate aviation department.
Exactly. So under this perspective, they argue the only true measure of the cost is the open market charter rate. They ask, if the CEO had to rent a comparable Gulfstream V from a private charter company for this exact itinerary, what would the free market charge him?
And what does that include?
The market rate factors in the fuel, the crew, the depreciation of the multi-million-dollar asset, the insurance, everything.
And if you price it that way, the cost of the trip to Orlando is $43,000.
So we have three numbers for the same event: $1,500, $11,000, and $43,000.
It is wild how you can bend the math depending on what you want to prove. I mean, if you're the CEO defending your compensation, you point to the $1,500 IRS rate and say, look, it's basically the same as flying commercial.
Exactly.
But if you're an activist shareholder angry about waste, you point to the $43,000 charter rate and accuse the CEO of looting the treasury.
This is why differential analysis is so vital. It strips away the rhetoric. You have to understand how a number is constructed so you can determine if it is relevant to the decision at hand. Executives often use the lowest, largely irrelevant metric to justify behaviors that genuinely cost the shareholders tens of thousands of dollars in real incremental cash.
We've spent a lot of time talking about costs that exist right now on a spreadsheet, like gas or insurance. But what about the costs that aren't on the spreadsheet yet?
The future costs.
Yeah, because it seems to me that ignoring relevant, tangible costs is bad. But ignoring future, Invisible costs is how companies actually destroy themselves. I want to talk about a famous cost-cutting disaster.
You're referring to the danger of the invisible differential cost. This usually happens when management becomes obsessed with a single, highly visible, avoidable cost and develops severe tunnel vision, completely ignoring the future revenue that will be lost as a direct consequence of their actions.
Let's look at a classic business case involving Dell Inc., the computer manufacturer. A while back, Dell executives looked at their balance sheet and decided that their customer service operations were too expensive. They wanted to cut costs. The strategy they chose was massive outsourcing. They moved a huge portion of their call centers overseas.
Outsourcing customer service is a standard move, but Dell compounded the risk with a fatal error in how they designed the operation. They staffed these new call centers largely with temporary workers, and they created an incentive structure that practically guaranteed failure.
Right. They decided to measure the performance of these workers primarily by the length of the phone calls. The metric was called average handle time. They rewarded the temp workers strictly for getting the customer off the phone as fast as humanly possible.
Think about the mindset of management here. The avoidable cost they are hyper-focused on is the hourly wage of the call center representative. By keeping the calls as short as possible, they process more calls per hour, which drives down the labor cost per interaction. The math looks brilliant on a short-term spreadsheet.
But think about the reality of a frustrated customer. Your computer is broken. You are stressed. You finally get through to a human being, and that human being is financially incentivized to rush you, to offer a quick, unhelpful fix, and to hang up on you so they can hit their metrics.
It's terrible.
It is a recipe for absolute fury.
The unintended consequences were immediate and catastrophic. Because the problems weren't actually being solved, the customers had to call back a second, third, or fourth time.
Which completely defeats the purpose.
Exactly. The total volume of calls skyrocketed, offsetting the wage savings. But much worse than that was the invisible future cost.
The destruction of their reputation.
Dell's internal customer satisfaction surveys plummeted. Specifically, the crucial metric of likelihood to repurchase fell off a cliff. When a customer has a terrible experience trying to fix a $1,000 laptop, they don't just get mad in the moment. They make a firm, quiet decision to buy their next laptop from a competitor.
And that lost future revenue, the computers they will never sell to those angry customers, is a massive, highly relevant differential cost. But because it doesn't show up on today's balance sheet, the executives completely ignored it when making the decision to outsource.
Exactly. They were blind to the differential revenues. When they finally realized they were bleeding market share, the fix was agonizingly expensive. Dell had to spend $150 million to completely reverse course. They brought thousands of call center jobs back to full-time workers in North America.
And they had to change the metrics, right? They had to stop rewarding speed and start rewarding actual solutions.
They did. They changed the incentives to focus on resolving the issue on the very first call, regardless of how long it took. And the results proved the point. Once they prioritized solutions, Dell started receiving 2 million fewer customer service calls every single quarter. Their customer satisfaction and repurchase intent scores rebounded.
It is a powerful lesson. If you only look at the wages you can avoid today, you are completely blind to the millions in revenue you will lose tomorrow. The ecosystem of a decision is always bigger than the immediate line item.
We see this exact same blind spot consistently when companies try to navigate environmental regulations and manufacturing processes. Environmental compliance is incredibly complex, and the costs are often hidden deep within the operational structure. Managers frequently leave these costs entirely out of their differential analysis when comparing equipment.
There is a vivid example of this in manufacturing regarding spray painting systems. Imagine a company makes metal parts, and they need to paint them. They are evaluating two different systems, a traditional solvent-based system and a newer powder-based system.
A manager looks at the initial proposals. The traditional solvent-based system has a sticker price of, say, $400,000 to install. The powder-based system might cost significantly more upfront. If they stop their analysis there, they buy the solvent system, but they are stepping into a regulatory minefield.
Let's walk through how a solvent system actually works, because it sounds incredibly messy. The parts move along a conveyor belt, and workers or machines spray them with liquid solvent paint. A lot of that paint misses the part. To keep the air clear, the overspray is sucked into a wall of flowing water, which is called a water curtain.
The water captures the excess paint, and it all drains into a collection pit. Over time, this creates a thick, toxic sludge. And here is where the invisible costs detonate. Environmental protection agencies classify that specific paint sludge as hazardous waste. The moment you generate hazardous waste, you trigger a massive, continuous cascade of compliance costs.
You can't just throw toxic sludge in the dumpster out back.
Absolutely not. First, you have to apply and pay for specific permits just to be allowed to generate the waste. You must implement meticulous tracking and record-keeping systems detailing exactly how it is stored. Then, you have to dispose of it.
Right.
You have to hire specialized, licensed hauling companies to transport the sludge to secure disposal sites. For a standard manufacturing facility, the cost of hauling that sludge alone can be $55,000 every single year.
Wait, $55,000 a year just for the truck to take the mess away. And that's not all, is it?
Not even close. Because your employees are working near hazardous materials, you have to pay for specialized safety training. You have to purchase expensive, specialized insurance policies to protect the company against liability for spills or contamination.
What about the air and the water?
Solvents evaporate, releasing volatile organic compounds into the atmosphere.
Yeah.
You have to pay substantial fees to the state for those air emissions. And the water from that water curtain, it is contaminated. It cannot be flushed down the drain. It has to be processed through an on-site water treatment facility before it can be discharged, which costs tens of thousands of dollars in chemicals and energy annually.
Oh, wow. So when you add up the permits, the hauling, the insurance, the training, the air fees, and the water treatment, the annual cost of just managing the mess from this cheap solvent system can exceed $140,000 a year, every year.
Now, apply differential analysis and look at the alternative. A powder-based system does not use liquid solvents. The paint is a dry powder that is baked onto the part.
What happens to the overspray?
That's the beauty of it. The excess powder that misses the part can be vacuumed up, filtered, and immediately reused. There's zero hazardous waste sludge generated. It does not release toxic compounds into the air. It does not contaminate massive amounts of water.
So it bypasses that entire regulatory nightmare. The powder system avoids the $140,000 a year in compliance costs entirely.
Exactly. Even if the powder system costs twice as much to build initially, the differential savings and avoidable environmental compliance make it vastly cheaper over its operational lifespan. You have to map out the entire ecosystem of a decision. You cannot just look at the sticker price.
Okay, we are going to pivot now to what I genuinely think is the most counterintuitive, brain-bending part of this entire framework. We have talked about the traps of cost-cutting. Now I want to talk about the illusion of dropping an entire product line. This is where accounting math can actively lie to a business owner.
Oh, this scenario highlights the supreme danger of allocated common fixed costs. Misunderstanding this concept has literally driven companies into bankruptcy.
Let's set the stage. We have a retail business called the Discount Drug Company. They are a large store, and they're divided into three major departments: drugs, cosmetics, and housewares. Management is sitting down for their monthly review, looking at the income statement. The drugs department is highly profitable. Cosmetics is doing great. But the housewares department is showing a net operating loss of $8,000 for the month.
The red ink is glaring on the spreadsheet.
Right. Now, my immediate instinct, and I think the instinct of almost anyone running a business, is to say, cut it. Prune the dead branches. If houseware is losing $8,000 a month, shut the department down, clear out the shelf, and stop the bleeding.
It is a totally understandable reflex based on a surface-level reading of the data. But the trapdoor here lies in how the accounting department spreads out the costs of running the entire building. We have to break down the math of that housewares department using differential analysis to see what is really happening.
Let's walk through it slowly. The housewares department brings in $50,000 a month in sales. The variable expenses, the actual wholesale cost of the pots and pans and toasters they're selling, plus the sales commissions total $30,000.
Stop right there. That is the first crucial metric. The sales minus the variable costs gives us the contribution margin. $50,000 minus $30,000 is $20,000. This means the housewares department is generating a positive contribution margin of $20,000 every month. That is $20,000 of real cash that can be used to help pay for the fixed costs of running the store.
Okay, so it generates $20,000. But the accounting statement shows that housewares is being charged for $28,000 in fixed expenses. That is why it shows a loss. $20,000 in margin minus $28,000 in fixed costs equals an $8,000 loss.
But we have to ask the differential question. If we shut down the housewares department tomorrow, which of those fixed costs will actually disappear? We have to separate the avoidable fixed costs from the unavoidable fixed costs.
Let's go through the list of those fixed costs. First, salaries. The store pays $8,000 a month to the employees who specifically work in the housewares aisles. If we close the department, we let those employees go. That $8,000 is an avoidable cost.
Correct. That cost vanishes. Next, advertising. The store spends $6,500 a month specifically promoting housewares items in the local paper. If you close the department, you stop running those ads. That $6,500 is avoidable.
And there is $500 for insurance specifically covering the housewares inventory. We liquidate the toasters, we cancel that insurance policy, so that is another $500 avoided.
If we add those up, the avoidable fixed costs total $15,000. If you close the department, you save $15,000.
But wait, the accountants charged housewares with $28,000 in fixed costs. Where is the other $13,000 coming from?
This is the illusion of allocated common costs. Let's look at them. The accountants assigned $1,000 of the monthly utility bill to housewares based on the square footage they occupy. But if you empty those aisles, the store is still a massive open building. The air conditioning is still running. The lights are mostly still on. That utility bill is not going to drop by $1,000. It is an unavoidable cost.
They also allocated $4,000 of the master building lease to housewares. Same logic, right? You can't just tell the landlord, hey, we aren't using aisle 4 anymore, so we're going to pay less rent. The rent for the building is an unavoidable, common, fixed cost.
Exactly. The accountants also allocated $6,000 for general administrative costs. This is a portion of the salary for the store manager, the HR director, the accounting staff. If you close housewares, you aren't going to fire the store manager or the accountant. Those salaries remain unavoidable.
And finally, there is $2,000 a month charged for the depreciation of the custom-built shelving units used for housewares. But those shelves are already built. They have no resale value. They are a sunk cost. They are totally unavoidable.
So we have $13,000 of costs, rent, utilities, management salaries, sunk depreciation that are going to exist no matter what you do. The accountants just arbitrarily sliced them up and assigned a portion of them to housewares to make the books balance.
So here is the grand reveal. Let's say I follow my instinct and I ruthlessly shut down the housewares department because it looks like a loser. What actually happens to the company's bank account?
Well, if you close the department, you lose the $20,000 in positive contribution margin that housewares was generating.
And in return for losing $20,000, how much do I save?
You only save the $15,000 in avoidable fixed costs, the specific salaries and advertising. You do not save the rent, the utilities, or the management salaries.
So you lose $20,000 to save $15,000.
Precisely. If you drop the unprofitable housewares line, the entire discount drug company's overall net operating profit will actually plummet by $5,000 every single month.
That is mind-blowing. The accounting math makes the department look like a parasite, dragging the company down. But in reality, housewares was acting like a shield. It was absorbing $20,000 worth of the building's rent and overhead. If you kill the department, the drugs and cosmetics department suddenly have to carry the burden of all that rent and all those management salaries by themselves, and the whole company becomes less profitable.
This is exactly why you must never use a standard, fully allocated income statement to make decisions about adding or dropping segments. It will lie to you. It makes profitable segments look like losers by forcing them to carry the baggage of unavoidable common costs.
And beyond the strict math, there's another massive reality that standard accounting misses entirely. It is a qualitative factor, but a vital one. It is the magnet effect.
Ah, the cross-selling potential.
Right. Even if the housewares department truly was just barely breaking even, you have to think about how human beings shop. Someone might realize their coffee maker broke. They drive to the discount drug company specifically to buy a new coffee maker in the housewares department. But while they are walking through the store, they remember they need toothpaste, and they decide to buy some high-margin cosmetics, and they pick up a prescription.
Housewares generates the foot traffic that feeds the highly profitable departments. If you stop selling coffee makers, that customer goes to a big box competitor, and they buy their cosmetics and prescriptions there instead. We see this strategy everywhere. Think of a grocery store. The profit margins on staple items like milk, bread, and eggs are incredibly thin, sometimes non-existent.
They are essentially loss leaders.
Exactly. A grocery store manager isn't looking at the milk aisle and thinking, this is dragging down our profits, let's stop selling milk. They know that if they stop selling milk, the customers will abandon the store entirely. You have to evaluate the differential impact on the entire ecosystem, not just the isolated department.
This isn't just theory. If we look at the broader economy, massive corporations wrestle with this exact addition-subtraction illusion, especially when the economy takes a downturn and panic sets in. Look at what happened in the publishing world. When advertising revenues collapsed during a major recession, Condé Nast publications had to make brutal decisions. They ended up discontinuing 4 major magazines, including incredibly famous titles like Gourmet and Cookie.
And in the consumer electronics space, Pioneer Corporation saw their plasma TV sales drop catastrophically from 460,000 units to 290,000 units. They made the agonizing choice to completely withdraw from the plasma TV business.
In those life-or-death corporate survival situations, the executives could not rely on a simple profit and loss statement. If they just look at net income, they might have cut the wrong things. They had to perform deep differential analysis. They had to figure out exactly which corporate costs the editors, the printing presses, the manufacturing plants would genuinely vanish if they stopped printing a magazine or building a TV, and which cost the corporate headquarters the executive pensions would remain.
Right. If a product line cannot even cover its own specific avoidable fixed costs, then it is no longer a shield. It truly is a dead branch, and it must be pruned to save the tree. But you can only discover that by isolating the avoidable costs.
Okay, let's move along the business life cycle. Let's say you have a product. It is highly profitable. You are definitely keeping it. But now you have to decide how to build it. Do we make all the components ourselves in our own factory, or do we buy them from an outside supplier? This is known as the to make or to buy decision, and it's all about navigating the value chain.
The value chain encompasses every single step required to bring a product from conception to the customer's hands. It starts with sourcing raw materials, moves through research and development, parts manufacturing, final assembly, distribution, and ends with after-sales customer service.
And companies have a choice. When a single company owns and operates several of those sequential steps internally, like an automaker that owns its own steel mills and its own parts factories, we call that vertical integration. But the alternative is to outsource.
Deciding whether to integrate or outsource is one of the most critical strategic choices a company can make, and it is entirely dependent on differential analysis.
Let's look at Mountain Goat Cycles. They are a great company. They build high-end mountain bikes. Right now, they manufacture the heavy-duty gear shifters for their bikes in their own factory. Their internal accounting department runs a cost analysis and tells management it costs us exactly $21 to manufacture one gear shifter. We need 8,000 shifters this year, so that is a total internal cost of $168,000.
Then, an outside supplier, a company that specializes entirely in making bicycle gears, knocks on the door. They say, "We have massive economies of scale. We can manufacture those exact same shifters and sell them to you for only $19 a unit."
Okay, my consumer instinct kicks in immediately. $19 is less than $21. It feels like a total no-brainer. I look at this the same way I look at dinner. Sometimes it feels cheaper to just order takeout than to buy all the individual ingredients to cook a complicated meal at home. If the restaurant can bring it to me for $19 and it costs me $21 in groceries to make it myself, I'm taking the $19 deal and saving $2 a unit.
The logic is deeply intuitive, but once again, the initial number is a trap. You are comparing an external price, the $19, against an internal unitized cost, the $21 that is polluted with irrelevant, unavoidable overhead. We have to strip the $21 down to its avoidable elements.
All right, let's break down what actually makes up that $21 internal cost. The raw materials, the metal and plastic, cost $6. The direct labor, the hourly wages of the workers assembling the shifters, is $4. The variable manufacturing overhead, the electricity for the machines, the lubricants, is $1.
And they have a dedicated supervisor who oversees just the shifter production line. His salary breaks down to $3 per unit.
Okay, all of those are avoidable. If we accept the supplier's offer and stop making the shifters, we stop buying the raw materials, we reassign or let go of the hourly workers, we stop using the machine electricity, we no longer need the shifter supervisor. We avoid all of those costs. That is $6 plus $4 plus $1 plus $3. That equals $14 of true out-of-pocket avoidable cost.
Exactly. But the accountants got to $21. Where did the other $7 come from?
First, they included $2 per unit for the depreciation of the specialized milling equipment used to cut the metal for the shifters.
Stop there. That specialized equipment was purchased years ago. It has no alternate use, and it has zero resale value on the open market. Therefore, the cost of that machine is entirely sunk. The depreciation is just a paper entry. Whether you make the shifters or buy them from the supplier, that money is gone. The $2 is irrelevant.
Okay, sunk cost, cross it out. And the remaining $5.
The remaining $5 per unit is allocated general factory overhead. This is a portion of the rent for the entire Mountain Goat Cycles factory, a portion of the factory manager's salary, a portion of the property taxes.
Just like the housewares department. If we stop making shifters in one corner of the factory, The landlord doesn't reduce the rent for the building. The factory manager doesn't take a pay cut. Those costs are completely unavoidable.
Exactly. So the $2 in equipment depreciation is irrelevant. The $5 in general overhead is irrelevant. What is the true avoidable cost of manufacturing the shifters internally?
It's only the $14 of materials, labor, and direct supervision.
Now compare the alternatives accurately. The outside supplier wants to charge you $19 for a component that only costs you $14 out of pocket to make yourself.
It flips the entire decision. If we accept the cheap $19 offer, we would pay the supplier $152,000 for the year, but we would only save $112,000 in avoidable internal costs. Outsourcing would actually drain an extra $40,000 in cash from the company.
You would lose $40,000 simply by falling for the illusion of allocated fixed costs. The correct differential decision is to reject the supplier and continue making the parts internally.
That is fascinating. But we do see successful outsourcing happening on a massive scale globally. Companies aren't just doing it blindly. They must be finding situations where the differential analysis actually favors buying over making.
Absolutely. When the differential math aligns, outsourcing can be a massive strategic advantage. It allows companies to leverage the specialized expertise and economies of scale of global partners.
Look at Cessna Aircraft Company. They wanted to introduce a new, lightweight, entry-level airplane called the 162 Skycatcher. But manufacturing light aircraft in the United States is incredibly expensive due to labor and overhead. They realized that if they built the plane in their Kansas facilities, the price point would be too high for the entry-level market they were trying to capture.
So they engaged in a massive outsourcing initiative.
They partnered with China's state-owned Shenyang Aircraft Corporation. By shifting the manufacturing to Shenyang, where labor and production costs were vastly lower, Cessna saved an astonishing $71,000 per airplane in avoidable costs.
That differential savings completely altered the viability of the product. It allowed Cessna to price the Skycatcher just over $100,000, creating an entirely new market segment that would have been impossible if they had vertically integrated the production in Kansas.
And it isn't just about manufacturing heavy machinery. The service sector is heavily reliant on outsourcing, often not just to save money, but for a completely different differential benefit. There is an incredible example from the pharmaceutical giant Pfizer.
Pfizer recognized a massive inefficiency in how their highly paid talent was spending their time.
They had something like 4,000 managers and executives across the company. These are brilliant, highly compensated people. But internal studies revealed they were spending hours and hours every week doing menial, repetitive tasks. They were formatting PowerPoint slides, building basic Excel spreadsheets, doing rote internet research.
Which is a catastrophic waste of specialized human capital.
So Pfizer created a program called PfizerWorks. They contracted with specialized outsourcing firms in India. Whenever a Pfizer manager needed a presentation formatted or a spreadsheet built, instead of doing it themselves, they pushed a button and outsourced the task to the team in India. In 1 year, they outsourced over 66,500 hours of tedious administrative work.
Now, why is this a brilliant differential decision? Obviously, the hourly rate of the contractors in India is lower than the hourly rate of a Pfizer manager. But the true genius isn't just the wage savings. It is the differential benefit of freed up capacity.
Exactly, because what were those managers doing with those 66,000 hours instead of making PowerPoints?
They were doing the high-value work they were actually hired to do. They were formulating new competitive strategies. They were mentoring and motivating their teams. They were conceptualizing new drug developments. The massive qualitative benefit of returning 66,000 hours of strategic thinking to the organization vastly outweighed the cash cost of the outsourcing contract.
That concept of freed up capacity is the perfect transition into what I believe is the most unforgiving, haunting reality in all of economics. We just talked about what you gain when you free up time or space.
Yeah.
Let's talk about the dark side of that coin. Let's talk about opportunity cost.
Opportunity cost is a fascinating and often terrifying concept because it is entirely invisible. It never appears anywhere in a company's general ledger. It doesn't show up on a bank statement. No one writes a check for an opportunity cost.
So what is it?
It is the ghost of the path not taken. It is the potential economic benefit that is given up or foregone when you choose one alternative over another. If you have a constrained resource, time, money, factory space, and you use it for Project A, the opportunity cost is the profit you could have made if you had used it for Project B instead.
Let's apply this and see how it completely shatters the math we just did. Let's go back to mountain goat cycles. We just did a very rigorous differential analysis. We proved that it costs $14 out of pocket to make the gear shifters internally. The supplier wanted $19. We proved that outsourcing would lose the company $40,000. The case was closed. It was a lock. Make them internally.
But that analysis carried a massive unspoken assumption. We assumed that if we bought the shifters from the supplier, the factory floor space where the milling machines sit would simply remain empty and gather dust. We assumed the space had no alternate use.
Let's introduce the plot twist. What if that floor space is incredibly valuable? Let's say Mountain Goat Cycle's engineering team has just designed a brilliant, highly profitable new cross-country mountain bike. The market demand is huge, but the factory is completely full. They literally do not have the floor space to set up an assembly line for the new bike.
Unless they outsource the gear shifters. If they accept the supplier's $19 offer, they can rip out the shifter machinery, clear the floor space, and instantly begin manufacturing the new cross-country bike.
Now the entire landscape changes. Let's assume that if they build and sell this new cross-country bike, it will generate a net profit margin of $60,000 a year.
This is where opportunity cost enters the differential analysis. If they stubbornly decide to continue making the gear shifters internally just to save the $5 per unit, what are they giving up?
They are giving up the ability to make the new bike. They are giving up $60,000 in pure profit.
Exactly. So the cost of making the shifters internally is no longer just the $112,000 for materials and labor. The true economic cost must include the opportunity cost. It costs them $112,000 in cash plus the $60,000 in foregone profit. The total economic cost of making the shifters internally has skyrocketed to $172,000.
And what was the supplier asking for?
The supplier will sell you all the shifters you need for $152,000.
The math completely flipped. When you factor in the massive opportunity cost of the factory space, buying the shifters for $152,000 is actually the smarter move. Outsourcing saves you $20,000 in total economic value because it frees up the bottleneck to make the highly profitable new bikes.
It is a profound shift in perspective. You cannot make a rational decision without considering the value of the next best alternative.
This concept of opportunity cost becomes absolutely agonizing when you take it out of a factory and apply it to a service business, specifically when it clashes with customer relations. I want to look at the snowcat dilemma.
This is a brilliant illustration of how brutal economic reality can be. The scenario involves Brad and Carol Carafil. They own a business called White Grizzly Adventures, which operates in the mountains of British Columbia. They offer snowcat skiing and snowboarding.
For those who don't know, a snowcat is a massive treaded vehicle with a heated cabin on the back. It drives you up a mountain that has no ski lifts, so you can ski pristine, untouched powder. It is an incredible premium experience, and it's expensive. Guests pay roughly $300 a day for a seat in the snowcat.
Because it is a premium operation, they cap the number of guests. They only take 12 people a day. This ensures everyone gets fresh tracks and personalized service. It also means they are booked solid, often months in advance. Demand vastly exceeds supply.
But they operate in the remote wilderness, which means sometimes Mother Nature doesn't cooperate. Sometimes there is a massive blizzard or avalanche danger is too high and the guides say, it is not safe to operate today. The snowcat stays parked. The guests sit in the lodge.
Now, in the fine print of the contract the guests sign, it states clearly, no refunds due to weather or conditions beyond our control. From a legal standpoint, the business owes the guests nothing.
But from a human standpoint, these are passionate skiers. 70% of White Grizzly's business comes from repeat customers. A guest has traveled all the way to British Columbia, paid $300, and now they're stuck playing board games in the lodge. They're going to be disappointed, perhaps even angry.
The business owners want to maintain goodwill. They want to protect that 70% repeat customer rate. So the natural urge is to offer a refund. But let's look at the avoidable costs. What cost did White Grizzly actually save by not running the snowcat that day?
Almost nothing. The guests are still at the lodge, so they still have to be fed breakfast, lunch, and dinner. The ski guides are independent contractors who showed up for work, so they still have to be paid their daily rate. The only real cost avoided is the diesel fuel the snowcat didn't burn.
Exactly. There is no big pile of saved money sitting on the table to hand back to the guests. Issuing a full $300 cash refund to 12 people would be financially devastating to the business for a weather event they couldn't control.
Okay, so a cash refund is out. But what about a compromise? What about giving the guests a credit voucher? Management could say, we are so sorry about the weather, we can't give you your money back, but here is a voucher. Come back anytime next season, and you get a free makeup day on the snowcat.
This is where human intuition utterly fails us. Issuing a piece of paper that says free makeup day feels like it costs the business nothing. It feels like a brilliant, costless way to preserve customer loyalty.
But it isn't free, is it?
It relies entirely on the assumption of idle capacity. If a guest comes back next February and uses their free voucher on Tuesday when the Snowcat only has 10 paying customers, then taking them along truly is practically free. You just toss an extra sandwich in the lunch cooler. The marginal cost is near zero.
But we established earlier that White Grizzly is incredibly successful. They only take 12 people a day, and they are booked solid. There are no empty Tuesdays in February. Demand exceeds supply.
Precisely. Which means every single seat in that Snowcat represents a paying customer. If you give an angry guest a voucher today and they come back next year to redeem it, they are occupying a seat that absolutely would have been sold to a brand new customer for $300.
Oh, man.
By honoring the free voucher, White Grizzly must turn away a paying customer. The opportunity cost of being nice, the real economic penalty of issuing that voucher, is not the cost of a sandwich. It is $300 in pure foregone revenue for every single voucher issued.
If they issue vouchers to the whole cat of 12 people, it costs the business $3,600 in lost revenue the following year. It is identical to handing them cash.
It is an agonizing reality for a small business owner. Do you enforce the contract, keep the money, and risk alienating a loyal customer who might badmouth you to their friends? Or do you issue the voucher to be friendly, knowing that you are silently writing a $300 check against next year's revenue? Differential analysis doesn't tell you which choice to make, but it forces you to acknowledge the true, brutal cost of the decision. You cannot hide behind the illusion that a voucher is free.
That is heavy. It really shows how business is about balancing cold math with human relationships. All right, we have covered a lot of rules. We know to ignore sunk costs. We know to ignore allocated fixed overhead. We know to factor in opportunity costs. But now, I want to talk about a specific scenario that seems to break every rule of traditional pricing. It is called the special order.
A special order is exactly what it sounds like. It is a one-time, highly specific order from a customer that is not considered part of a company's normal day-to-day ongoing business. And because it exists outside the normal flow of operations, you analyze the profitability using a completely different set of rules.
Let's go back to our friends at Mountain Goat Cycles. They are chugging along, making their normal bikes. Suddenly, the phone rings. It is the purchasing director for the Seattle Police Department. The police want to buy 100 specially modified versions of Mountain Goat's standard city cruiser bicycle to use for neighborhood patrols.
This is a classic special order. Now, let's establish the baseline. The normal retail selling price for a city cruiser bike is $698. The normal unit product cost, which the accountants calculate by blending direct materials, direct labor, and manufacturing overhead, is $564.
So normally, they make a bike for $564, sell it for $698, and make a decent profit. But the Seattle Police Department is operating on a very tight municipal budget. They tell Mountain Goat, we want 100 bikes, but we can only pay $558 per bike. That is our absolute maximum.
On top of demanding a lower price, the police have special requests. They need heavy-duty welded brackets attached to the frame to hold police radios and nightsticks. The materials and labor for those brackets will add $34 in variable costs to each bike.
And there's more. They want the Seattle Police logo painted on the frame. Mountain Goat Cyclers will have to pay an outside design studio $2,400 to create and cut a custom stencil just for this order.
So as the manager of Mountain Goat Cycles, how do you react to this offer?
My immediate instinct is to hang up the phone. I look at the numbers and I say, this is a terrible deal. My normal cost to just build a standard bike is $564. You only want to pay $558. I'm instantly losing $6 on every single bike. Plus, you want me to add $34 in custom brackets. Plus, I have to pay $2,400 for a stencil I will never use again. I would be subsidizing the police department. Hard pass.
It sounds disastrous if you look at the fully loaded unit cost. But the expert defense here is that special orders bypass existing fixed manufacturing overhead. You cannot use the $564 normal cost to evaluate this deal. We must break it down.
Okay, let's dissect the $564.
It consists of direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. The fixed manufacturing overhead, the rent for the factory, the depreciation of the assembly line accounts for a large portion of that cost. Let's say $90 of that $564 is allocated fixed overhead.
And we know from the housewares example that allocated fixed overhead is an illusion. The factory rent is going to be exactly the same whether we accept the police order or not. The fixed costs are already being fully paid for by our normal daily production of retail bikes.
Exactly. The existing fixed overhead is completely irrelevant to the special order. We must ignore it. We only care about the incremental revenues and the incremental costs. Let's run the true differential math.
All right, incremental revenue. The police want 100 bikes, and they will pay $558 each. That is $55,800 in new incremental cash coming in the door.
Now, the incremental costs. What are the specific, variable, out-of-pocket costs to build these specific 100 bikes? We have the normal materials, labor, and variable overhead, plus the $34 for the special police brackets. When we strip out the fixed overhead, the total variable cost to build the modified police bike is only $508 per unit.
So for 100 bikes, that is $50,800 in incremental variable cost.
Are there any other incremental costs?
The custom stencil is a one-time cost triggered entirely by the specific order. So the $2,400 is an avoidable incremental cost.
So we add the $50,800 in variable costs and the $2,400 stencil cost. The total incremental cost of fulfilling the police order is $53,200.
Now we do the subtraction. We have $55,800 in new revenue minus $53,200 in new costs. The result is a net profit of $2,600.
Even though the 558 police price was beneath the normal 564 unit cost, accepting the special order actually increases the company's total net operating income by $2,600. Because the fixed costs were already covered, almost the entire margin above the variable cost flows straight to the bottom line.
It's like finding free money. There has to be a catch. You can't just run a business selling everything below cost.
There is a massive structural caveat to the special order rule. This mathematical trick only works if the factory has idle capacity.
Meaning they have the physical space, the machinery, and the worker hours available to build these 100 extra bikes without disrupting their normal business.
Precisely. If Mountain Goat Cycles is already operating at 100% capacity, running 3 shifts a day just to meet the demand of their regular customers paying full price, then accepting the police order triggers an opportunity cost.
Because to build the 100 police bikes, you would have to pull workers off the main line. You would have to delay or cancel orders for 100 regular city cruisers.
And you would be giving up the $698 regular price to accept the $558 police price. You would lose money. Special orders are incredibly profitable, but only when they are used to soak up idle capacity that would otherwise be wasted.
That brings us perfectly to an incredibly critical concept. What happens when you do not have idle capacity? What happens when a business is running as fast as it can, but it still can't meet demand? We are calling this part the choke point.
We are entering the realm of the theory of constraints. Every single business process and system on Earth has a limit. It might be the square footage of a retail floor. It might be the number of available surgeons in a hospital. It might be the hours in a workday. When a limited resource restricts your ability to satisfy market demand, you have a constraint.
And the specific step in your process that dictates the maximum speed of the entire system is called the bottleneck.
Managing that bottleneck is the difference between massive profitability and systemic failure.
Let's look at how to manage a bottleneck with Mountain Goat Cycles. Along with making bikes, they manufacture these heavy-duty saddlebags that attach to the bikes, called panniers. They make 2 different models, a mountain pannier designed for rough trails and a touring pannier designed for long road trips.
Let's look at the financial profile of each product. The mountain pannier sells for $25. The variable costs to make it are $10, so it generates a contribution margin of $15 per unit. That is a 60% margin ratio.
That is a highly profitable product. Now the touring pannier, it sells for $30. The variable costs are $18, so the contribution margin is $12 per unit, a 40% margin ratio.
If you ask a standard manager which product to prioritize, the answer is obvious. The mountain pannier is clearly superior. It generates $15 of profit compared to $12. It has a much higher margin ratio. You want to sell as many mountain panniers as possible.
But reality interferes. The factory is operating at absolute maximum capacity. They cannot produce enough bags to satisfy what the market wants to buy. The constraint, the bottleneck, is a highly specialized, heavy-duty stitching machine that is required to sew the thick canvas for both types of bags.
The factory only has one of these stitching machines. It can only run for a maximum of 12,000 minutes a month. The sales department reports that the market wants to buy 4,000 mountain bags and 7,000 touring bags this month.
Let's calculate the time required. The mountain bag is complicated. It takes 2 minutes on the stitching machine. 4,000 bags times 2 minutes is 8,000 minutes. The touring bag is simpler. It only takes 1 minute on the machine. 7,000 bags times 1 minute is 7,000 minutes. To satisfy the whole market, we need 15,000 minutes on the machine.
But you only have 12,000 minutes. You have a 3,000-minute shortfall. You must cut production somewhere. You have to prioritize. Which bag do you build first?
My instinct, again, is to push the mountain pannier. It makes $15 a profit. $15 is bigger than $12. Prioritize the high-margin item.
That is the illusion of the unit margin. When you are operating under a constraint, the profit per unit is entirely the wrong metric. You must calculate the contribution margin per unit of the constrained resource.
Profit per minute of machine time.
Exactly. Let's do that math. The mountain bag generates $15 of profit, but it consumes 2 minutes of the bottleneck. $15 divided by 2 minutes equals $7 of $15 of profit generated per minute.
Okay, now the touring bag. It only generates $12 of profit, but it only consumes 1 minute of the bottleneck. $12 divided by 1 minute equals $12 of profit generated per minute.
Look at how the math flips. Every single minute that stitching machine spends working on a touring bag generates $12 for the company. Every minute it spends on a mountain bag only generates $7.50. When time is your limiting factor, the lower margin touring bag is vastly superior.
That is incredible. To maximize the total profit of the company, you don't chase the highest unit margin, you maximize the efficiency of the bottleneck.
Precisely. So the optimal strategy is to satisfy the entire market demand for the touring bags first. You build all 7,000 touring bags. That consumes 7,000 minutes of machine time. You have 5,000 minutes remaining for the month. You use those leftover minutes to build 2,500 mountain bags. If you prioritize the mountain bags first, you would run out of time and your total monthly profit would be significantly lower.
This concept of the choke point doesn't just apply to sewing canvas bags. It dictates the reality of the most massive industrial supply chains on the planet. I want to talk about Boeing and the 777 jet.
A phenomenal example of how a tiny constraint can paralyze a giant system.
The Boeing 777 is a marvel of modern engineering. We are talking about a commercial airliner that sells for well over $200 million apiece. It is incredibly complex, comprising millions of individual parts sourced from all over the globe.
A few years ago, Boeing was in the middle of a massive production run, building a fleet of 777s for Emirates Airline. The demand was high, the contracts were signed. But suddenly, the deliveries ground to a halt. Massive, fully assembled airplanes were sitting idle on the tarmac in Seattle, undeliverable.
Why? Was there a problem with the jet engines, the avionics, the landing gear? No, the entire multi-billion-dollar production line was paralyzed by a bottleneck at one specific, relatively small supplier in Germany, a company called Cell GmbH.
And what component was this German company responsible for?
The cooking galleys, the little kitchens where the flight attendants prepare the meals.
Think about the scale of that. A $200 million aircraft cannot be delivered, and Boeing cannot collect the massive payment from the airline because they are waiting on a kitchen installation that represents a tiny fraction of the plane's total value.
The German supplier simply couldn't manufacture the galleys fast enough. They lacked the factory floor space and the specialized labor to meet Boeing's production schedule. The galley became the constraint that dictated the speed of the entire Boeing 777 supply chain.
And how do they resolve it?
They had to break the bottleneck. The supplier had to invest massive amounts of capital. They leased additional factory space. They rapidly hired and trained over 250 new workers just to increase the throughput of those galleys and get the planes flying.
It perfectly illustrates the rule. The speed of any system is entirely determined by the speed of its tightest constraint. If you do not identify and manage your bottleneck, it will manage you.
We're going to wrap up our deep dive today by taking everything we have learned from Cynthia's college road trip to the CEO's Gulfstream jet to Dell's call centers to Boeing's supply chain, and we're going to scale it up to the ultimate macro level. We're going to look at the municipal level, where billions of taxpayer dollars are spent. We're going to examine the ultimate illusion, convention centers.
This is a fascinating arena because it demonstrates how differential analysis can be deliberately ignored or manipulated when massive political and economic interests are at play.
And I want to be really clear here for you listening. We're not taking a political stance on local spending. We are just reporting exactly how the textbook analyzes the pure economics of these projects.
Right. To set the context, across the United States, there has been a decades-long building boom. Local politicians and city councils have authorized the expenditure of billions upon billions of dollars to build massive new convention centers or to wildly expand existing ones.
Which would make sense if there was a booming market for conventions. But the macroeconomic reality is the opposite. Over the last couple of decades, actual attendance at trade shows and conventions across the country has been steadily declining. The advent of digital communication, virtual meetings, and tightened corporate travel budgets has permanently shrunk the demand.
So we have a situation where demand is shrinking, yet cities are spending billions to massively increase the supply. How do politicians justify spending hundreds of millions of dollars on an empty building?
They rely on economic impact studies. When a city proposes a new convention center, they hire specialized consultants to produce a massive report. These reports inevitably conclude that the new convention center will bring a massive, favorable economic impact to the area, creating jobs and flooding the local businesses with cash.
But according to the strict principles of differential analysis we have learned today, these studies are often deeply flawed. They are designed to create an illusion. They mingle irrelevant data to justify a predetermined decision.
Let's break down exactly how these studies distort the differential math. Flaw number one is the misclassification of local spending as a new differential benefit. The consultants use a concept called the substitution effect to inflate their numbers.
Give me an example of the substitution effect.
Let's look at a real-world case involving Portland, Oregon. The city proposed spending $82 million to expand their convention center. The voters actually overwhelmingly opposed it, but the politicians found a way to proceed anyway, relying on the projected economic impact.
And what happened after they spent the $82 million and built it?
Data revealed that more than 70% of the people who actually attended events and spent money at the newly expanded convention center were locals. They were residents of the Portland area.
Okay, they are spending money. Why isn't that a benefit?
You have to ask the differential question. If the convention center had not been expanded, what would those local residents have done with their entertainment dollars that weekend? They wouldn't have burned the money in their backyard. They likely would have spent it in Portland anyway. They would have taken their family to the local zoo or an art museum or out to a local restaurant or to a movie theater.
So the money was already inside the local economic ecosystem. The convention center didn't create new wealth. It simply cannibalized it from other local businesses.
Exactly. From a differential perspective, shifting a dollar from a local restaurant to a local convention center creates zero net new economic benefit for the city. But the consultant studies routinely count all of that local spending as a massive, positive differential impact to justify the construction cost.
That is a huge blind spot. It's moving money from your left pocket to your right pocket and claiming you got a raise. What is the second major flaw in these studies?
Flaw number two is the systemic ignoring of necessary concessions. Remember the macroeconomic reality. The supply of convention centers is huge, and demand from trade shows is shrinking. It is a buyer's market.
So if you are a massive trade show, you can pit cities against each other. You say, hey, Chicago, Las Vegas is offering us a great deal. What can you do for us?
Precisely. To actually attract a major show to their shiny new building, cities are forced to offer massive economic incentives. They routinely waive the rental fees for the convention center entirely. They give the space away for free. Sometimes they even subsidize the hotel rooms or offer massive tax rebates to the organizers.
The city gives away the farm just to get the foot traffic.
But here's the illusion. The lost revenues from those waived rental fees and the hard costs of those municipal subsidies are almost entirely excluded from the consultant's initial economic projections.
So the study claims the city will make millions in rent, but the reality is they have to give the rent away for free just to compete.
It is the ultimate violation of differential analysis. They include massive amounts of irrelevant data, the local spending to inflate the benefits, and they systematically ignore highly relevant future costs, the concessions, to hide the true financial burden. It creates a financial fantasy that leaves taxpayers footing the bill for underperforming assets.
It all comes back to the same fundamental errors, whether it is Cynthia agonizing over the sunk cost of her Honda or a mayor trying to justify an $80 million building. The math of reality does not change.
The rules of logic are universally applicable.
Which brings us to the end of our journey today. We have unpacked an immense amount of information. We've explored how a simple road trip exposes our psychological attachment to sunk costs. We've seen how averaging fixed and variable numbers gives executives the cover to justify flying a private jet for $1,500. We've uncovered the hidden, invisible costs of environmental disasters and furious customers that result from short-sighted cost-cutting.
We dismantled the addition-subtraction illusion, proving that sometimes an unprofitable department is actually a shield absorbing unavoidable overhead. We navigated the make-or-buy decision, emphasizing the value of freed-up capacity. And we faced the unforgiving reality of opportunity costs, realizing that sometimes a free snowcat voucher actually costs you $300.
The golden rule connecting every single one of these scenarios is clear. Only look at what changes. Have the emotional discipline to ignore the sunk costs that you can never ever get back. Have the analytical rigor to identify and ignore the common fixed overhead that will not change regardless of your choice. Strip away the noise and isolate the true differential costs and the true differential benefits.
If you can cultivate that discipline, you will see the world with a clarity that most people never achieve.
It is an incredibly powerful framework. Now, before we sign off, I know you always like to leave us with something to chew on. We've spent a lot of time talking about corporate strategy and massive budgets, but I'd love for you to bring this home. Give us something deeply personal that builds on what we've learned today.
I want you to apply differential analysis, not to your wallet, but to your calendar. We have spent an hour talking about allocating money, but money is a renewable resource. Time is your ultimate constrained resource. It is the only true bottleneck in your life.
You can always make another dollar, but you can never make another minute.
Exactly, and yet we constantly apply the worst kinds of flawed accounting to our time. We stay at terrible jobs where we are miserable, or we stay in bad relationships, or we cling to destructive habits, and the justification we use is almost always a sunk cost.
We say, I've been at this firm for 5 years, I can't leave now, I've invested too much. Or, I've been reading this 800-page book for 3 weeks, I hate it, but I'm halfway through, so I have to finish it.
It is the exact same emotional fallacy as Cynthia feeling she had to drive her car because she paid $24,000 for it. The 5 years at the bad job. The 3 weeks reading the bad book. That time is gone. It is a sunk cost. You cannot get it back. It is mathematically, fundamentally irrelevant to your future.
You have to wipe it off the whiteboard.
You do. The only question that matters, the true differential question you must ask yourself every day is, what is the benefit of your next hour? If you spend your next hour staying in that job or continuing that habit, what is the incremental benefit? And more importantly, what is your personal opportunity cost? By staying where you are, what amazing thing are you forging the opportunity to do? Apply differential analysis to your time. Ruthlessly cut out the sunk costs of your past, and you might just change the entire trajectory of your life.
What an incredible perspective. Cut out the noise, ignore the sunk costs, and fiercely value the opportunity cost of your next hour.
Thank you so much for joining us on this deep dive. We hope you take this framework, look at your own choices with fresh eyes, and go out and make some ruthlessly rational decisions today. Until next time.